Hello, in this lecture we're going to work a problem which will be recording the bonds, and at this point we're going to report the bonds at a premium. So we're going to have the information over here on the left hand side. Support accounting instruction by clicking the link below, giving you a free month membership to all of the content on our website, broken out by category, further broken out by course. Each course then organized in a logical, reasonable fashion, making it much more easy to find what you need than can be done on a YouTube page. We also include added resources such as Excel practice problems, PDF files, and more, like QuickBooks backup files when applicable. So once again, click the link below for a free month membership to our website and all the content on it. We're going to post that to this blue area, or we're going to record that to the blue area here, make the journal entries related to the information, and then we'll post that to a quick trial balance on this side so we can see the activity that would happen in relation to other accounts over here. We have the beginning trial balance. We can see that we are in balance, the assets in blue. We've got the liabilities in orange, and we're going to be working within liabilities because we're going to be talking about bonds payable in this case. And then we've got the equity, retained earnings, and sales. We can see, and expenses. All we have are sales here of the 700. We have net income of 700, which is just the sales. There are no expenses represented at this point. We can see that we are in balance in that the debit accounts do not have brackets and the credit accounts do. Therefore, the debits minus the credits equals 0. So this green 0 represents the fact that we are in balance. We're going to record our transactions or post them here and then see what happens to the ending trial balance as we go through this process so that we can see the information within context of a trial balance. We also have this worksheet here which will be amortizing the interest and the premium. So let's see what our information says over here. Just want to contrast this a bit with a prior video that we had where we had a discount. So this is going to be basically the same type of information, but we are going to be giving the bonds at a premium in this case. So remember what we're talking about here. When we talk about bonds, we have to think about who's giving the bond and who's receiving the bond. We are giving the bond. The bond is similar to a note in that we are going to issue the bond, we're going to receive money on the date of issuance, and then we will pay the interest and principal of the bond in accordance with the agreement of it. So it's similar to a loan type agreement. We're going to record journal entries and post to the trial balance. So first item here on 1-1, we're going to issue bonds which pay interest semi-annually. So basis of this bond, unlike a note, one of the most common types of notes that we see are a mortgage and or a car payment, something like that, where we pay off monthly, and oftentimes we pay off both part of the interest and or fully interest, well, part of the interest and part of the principal. In terms of, that doesn't have to be the only way a note is written or a bond is written or some kind of debt is written. In this case, we're going to pay off the interest only, and instead of paying it off on a monthly basis, we're going to pay it off semi-yearly, meaning, you know, at twice a year basically. So that's how we're going to record this, and many notes can be formatted in many different ways. Most common notes related to things that people do most often and have most awareness of are monthly, and they are in format where they pay off both the interest and the principal, such as a mortgage or a car payment. So in this case, it's going to be a 15-year note. It's going to have a face value of $240. It's going to have an issue price of $270. Interest rate on the bond is 8, and market rate is 5. So first thing we want to distinguish on the note is if it was a note, then the thing that we would often change in order to compete on the market to be able to sell it would often be the rate. So as opposed to a bond, if it were a note, then if we couldn't sell the note at a rate of 8% that we were going to pay back to the market, then what we would do is adjust it. We would say, well, we're going to bring it down to the market rate, in this case, of 5%. In the case of a bond, we can think of it as it's kind of already written. It's already written on paper, or it's already written in stone. We can't really change the rate. If you look at the piece of paper, the bond says that it's going to be for 15 years. It's going to have a specific date that's already on there. It's got $240,000 being the face value. That's how much is going to have to be paid back at the end of the 15-year. And the interest on the bond in this case is 8%. It's already written there. You can think of it as like written in stone. Can't change it. Therefore, what can you change if you can't basically, this doesn't match the market? And in this case, the market is giving a return of 5%, which is less. So if an investor's coming to us, we don't want to loan them the money and be paying interest at 8% when we could reduce the rate to 5%. That's what the market is. We can't change the rate on the bond, but what we can do is when we sell the bond, we're going to say, okay, we'll pay you 8% on the $240 that you give me today. However, because the market rate is 5% and we're paying 8% on this note, we would like to receive the difference. Basically, in this case, we're going to charge for this note $270. So you give us $270 now, we give you $240 at the end of the 15 years back. However, we're going to pay 8%, which is the amount of interest on the bond. And if you go anywhere else, you're only going to get 5%. So that difference is basically supposed to be making up the interest on the note. So let's record this and see what happens. First of all, is cash affected? Yeah, cash is affected. We're going to get money. We're issuing the bond and we are receiving money for it. Cash is a debit balance. We want to make it go up. Therefore, we're going to do the same thing to it, which in this case would be a debit. So I'm going to right click on cash. We're going to copy cash in G20. I'm going to put my cell in C20, right click, paste it, 1, 2, 3. We'll put the cash on top. And how much cash are we going to receive? We're going to receive the $270, not the face amount of the bond, but the amount of cash that we're actually going to charge for it. $270. Any problem would have to basically give you that information. How did they come up with the $270? That's a different story we could talk about at a different time. But it's basically calculated between the difference in the rates. All right, and then what are we giving? We're going to give a bond payable in this case. So here's the bond payable. It's a liability, and we're going to pay back that liability at the end. We owe it. Liabilities have credit balances. We need to make that bad thing go up. Therefore, we're going to do the same thing to it, which in this case is another credit. So we're going to credit the bond. I'm going to right click and copy the bond. I'm going to put that in C21, right click and paste it, 1, 2, 3. And how much are we going to credit it for? We're not going to credit it for the $270 in this case. We're going to credit it for the face amount of the bond. Why? Because that's how much we are actually going to pay as of the end of the bond when it is terminated, when it's done after 15 years, which will be a credit of $240. I'm going to represent the credit with a negative number for the purposes of this week worksheet, $240,000. There we have that. Now we can see that, of course, the debits do not equal the credits. We're out of balance by, in this case, $30,000. We need another $30,000 credit in order to put this thing in balance. We could think of that as the negative sum. I'm going to do this with a plug formula. So I'm going to say instead of equals negative, SUM, brackets, and then highlight these 4 cells. The 270 minus the 240, because that's a negative number, gives us the 30,000. Now we can see that the 2 credits add up to 270. The debits add up to 270. If I highlight all of these cells, then it adds up to 0. We are now in balance. So now the only question is, what are we going to put that account to? And if we take a look at our trial balance, what we're going to put it into is the premium on the bond payable. Meaning it's kind of like part of the bond, but we're going to record it in a separate account. And it's going to basically be obviously what it is it's cash that was paid over the face amount of the bond. The reason cash was paid over the face amount of the bond is that the rate on the bond was 8% and the market rate is 5%. Therefore, we're basically saying that the difference will be interest, and we are going to write off that premium over the life of the bond. And in this problem, we're going to do that with a straight line method. So we're just going to take it at a premium, and by the end of the 15-year period where that premium will go down to 0, we're basically going to amortize it in a similar fashion as we depreciate, like a straight line depreciation on equipment. So that's where the account's going to go. I'm going to copy that in G24, right click and copy, put our cursor in C22, right click and paste 1, 2, 3. Oftentimes people have a problem with determining if it's a premium or a discount that we are talking about. And I often think that it's easier to think of yourself as the person purchasing something to think about whether it's a premium or a discount. So obviously we are the people issuing the bond, the company issuing the bond in this case. But if we were the person buying the bond, then if the sticker price said it was $240 and we bought it for more than that, that's going to be a premium. If they say there's a sale and we bought it, the sticker price says $240 and we're going to buy it for less than that, then that would be a discount. So most people can kind of think of the word discount in terms of like a sale. We got a discount of it when we're purchasing it. Of course, when we're issuing the bond now we're the person issuing the bond and we're issuing it at a premium, meaning the face amount is here and we sold it for more than the face amount, therefore we sold it at a premium. Alright, let's post this out and see what happens. We're going to post the cash first. Here's cash here, or here's cash here. We're going to post it to I-20. So in I-20, we're going to select equals and point to this 270. This is a debit. This is a debit. Those are the same thing. That's going to make this go up in the debit direction to 990. Then we have a note payable. Here's the note payable. We're going to post that to, or the bond payable, I should say. Here's the bond payable. We're going to post that to bond payable here. We're going to post it to the blue area in I-23. We're going to select equals and point to that 240. It's going to make this go up in the credit direction to 240. We are of course out of bounds by the last part that we must post at this time, which is going to be the premium. So here's the premium, here's the premium. We're going to post it to the middle column in I-24. We'll select equals and point to that 30,000. That's going to make this go up to 30,000 and put us back in balance. So note what we have here is these are basically related accounts. The bonds payable, if I highlight both of them, we have a carrying amount of 270 at this time. Okay, and then the second item that will happen on 6/30, we're going to say 6/30, record bond interest and straight line amortization of interest. So the first thing we can think, is cash affected? Is cash affected? It is in this case, because we're going to pay off the interest on the bond. So we're paying, we borrowed money, we borrowed the 270, issuing a 240 face amount of the bond. Now we're paying off we're paying off the interest, the use of that money. So we have a debit balance, we need to make it go down, so we're going to do the opposite thing to it, which in this case will be a credit. So I'm going to copy the cash, I'm going to right click, copy the cash, I'm going to put that under the date so that the credits will go on the bottom. So we are in C25, right click and paste 1, 2, 3. And then the amount, the question is, how much should we credit? If we pull out the calculator, sometimes it's easier to actually do this stuff in a calculator and then pull it over. So we'll do it two ways here. We could say, first question is, what are we paying interest on? And which rate do we use will be the second question. We're going to use the face amount, not the amount that we received, because we said that we were going to pay interest on the face amount of the bond. It's already been written, like that's the part that's written in stone. So we have 240 that's been written in stone on the paper, 240,000. We're going to multiply that to the other thing that was written in stone on the piece of paper. Well, it was written on the piece of paper. We're thinking it's written in stone because we can't change it. And that's the interest on the bond. It's not the market rate. It's going to be the interest that's been written on the bond. You could think of it as being on the bond. We couldn't change that. That's why we had to issue it at a different price than the face amount. Therefore, we're going to multiply it times, and I'm going to do this in a decimal, 0.08, and enter. So we have 19.2. However, remember that anytime we think about interest, if we say that there's you're going to pay 5% mortgage interest on the home, that doesn't mean 5% per month. The interest, even though we never say per year, is basically per year. So that would be the interest if it was for an entire year. However, we're going to pay it semi-yearly or every 6 months. So there's a couple ways you can think of that. I'm going to do it with a ratio here. So I can think about it as dividing it by 12, and that means that we would have interest of 1/6, interest being like the rent on us borrowing the money of 1,006 times 6 months, because it's half a year, and that will give us the 9.6. I'll do that same calculation over here, slightly different. So we're going to put our cursor in E25, I'm going to select negative, and we'll do that same thing. I'm going to say it's 240 face amount times the rate of 0.08, and this time instead of saying 9/12, which is half a year, 1/2, I'm going to say just divided by 2, half a year, and then enter. And so that'll give us that 9.6, and Then, of course, the debit is going to go to the bond interest. That's going to be an expense down here, expense similar to like rent expense. We are using this money, similar to us using a building in order to help us generate revenue. Expenses have debit balances. They only go up. We're going to do the same thing to it, which is another debit. So I'm going to copy the bond interest expense down here on the income statement, put it in C24, right click and paste 1, 2, 3. Now the tricky thing is that we're not going to debit just the 9.6. We have another issue here, that issue being the bond premium on the bond. This $30,000 here, we need to amortize over the life of the bond. So we're basically just going to divide it out by the number of payments, and then